Good morning, welcome to Morning Markets on Thursday the 13th of February. Going to do two things today. One, touch on just what's happened overnight in markets, and then look at a couple of charts that I think are interesting and what we've been touching on within some of our team meetings. Firstly, in overnight markets slightly weaker and futures in the US indicating a slightly weaker open. Why is that? We've seen the Chinese government change how they are classifying cases of the coronavirus, moving from laboratory diagnosis to clinical diagnosis. This has had the effect of increasing the number of those that are thought to be infected. So the market is reappraising that after seeing a gradual plateau and decline in that rate over the past few days. However, that didn't stop both the European, the Euro Stoxx 600 hitting an all-time high yesterday, and that followed through with all three of the main US indices yesterday hitting all-time highs. Why is that? Well, we've touched on a few aspects of liquidity and how financial conditions themselves are relatively easy. I thought it's better if we look at that in a couple of charts. So we've put together some charts to help people think about this. This is a chart that the ECB produced. It looks at the country level financial stress. What they don't have is a composite level for the Eurozone, but what I've taken here, Germany and France, just to give you some context. So the chart goes back to 1995, and what you can see here is that we've some of the easiest financial conditions in Europe. Why is that? Well, we've very accommodative monetary policy. How's that manifesting itself? Through negative rates. If we then move on to the US, again, this is an indicator that the St. Louis Fed put together. It looks at the financial stress through a number of various different indicators here. And what you can see here, we have a chart going back to 1993. Obviously, the very tight financial conditions in the US through the financial crisis. But then if we look today, again, very similar to what we're seeing in Europe, financial conditions, very easy. So with easy financial conditions, one of the things that's not really as yet feeding itself through into at all is inflation. We touched yesterday on the challenges that the Fed Chairman Jay Powell discussed around inflation running consistently below target. I just thought I'd really illustrate this for you. So from 2010, post-financial crisis, where the Fed have a 2% PCE inflation target, this is the white line, it's barely been achieved. That illustrates one of the challenges. So we're a long time into a recovery, but we don't have any inflation in this system. Furthermore, if we look at employment, unemployment is at record lows. This is a chart going back to 1971 for the US. You can see the unemployment rate at about 3.6, 3.8%, I think it is. So again, close to, at a 50-year low. So what we would think there, we would be seeing some wage pressure. We're not seeing that in the system. So one of the challenges that we've touched on and why the ECB, the Fed are looking at their policy is this inflation target actually working? That's something that we may come back to and explore in later podcasts. Hopefully you've found that interesting, and we'll see you again tomorrow.